So what are the advantages for the institution of implementing a relationship-based banking mentality? I think first and foremost, it's the likelihood of winning the borrower's future loan business. Right? If they've had a good experience, they're more likely to come back to the same institution and even possibly overlook discrepancies in pricing, which, as a matter of fact, I've got a May article from American Banker magazine here in front of me, and it states, just reading one of the paragraphs, the art of customer service has become increasingly important as interest rates stay low and competition remains stiff. A recent study by CS Consulting Group found that small banks that focus on service rather than offering the lowest pricing had more success. So certainly the relationship comes into play there, which then means more potential revenue, not only from additional lending, but also from multiple product lines, as well as referrals. And lastly, as related to that article, that many borrowers would be willing to pay a slight premium to the local bank based on that relationship that's been developed and any additional services, as opposed to considering price only. As far as the advantages to the borrower, Joe, would you like to comment on that?
Sure. Well, as he says, which we said on the slide, the longer duration of the relationship, greater credit availability and understanding of needs. The longer you have a relation with somebody, the better off the whole situation is. And I like to refer to it as more, I like to see lenders or relationship managers really become, for small businesses especially, the treasurer, essentially, of the business. In other words, acting as the treasurer, knowing when they have financial needs, knowing when they have excess cash, for instance, to pay down debt or invest, knowing how to manage help them with their management of cash and so on. And I think this leads to proactive lending versus reactive. And proactive is when you're actually been able to tell the borrower when they're going to probably need funds or need to borrow, versus the borrower coming to you and saying, hey, I need to borrow some funds to do this or do that. So if you've got a very strong relationship with your borrower, you can know these things ahead of time. It's also a good chance to know when to present other products within the bank by doing that. Lower collateral requirements, this one always scares me because this tends to happen. In fact, we were discussing earlier today a bank up in North Dakota, and this is what's going on. But I mean, let's face it, back in 2004, 2005, 2006, and so on, this is what began to happen with a lot of these bad relationships, in that their focus on the collateral was not as strong as it should have been. And it's still going on to some degree. And in fact, I read, as Jay mentioned, there was another article on one of the LinkedIn groups that I belong to, talking about the need to reduce covenants and so on, and that the bigger banks are going to covenant light loans. And I'd say covenant light loans may work well for a big borrower that's been around for quite some time, has strong financials and so on. But with most small businesses and community bank type lending, I would say that that becomes a very slippery slope. So looking at lowering the collateral requirements is possible, but it's something that can be a real problem. And obviously, as I said before, becoming a part of the borrower versus being a vendor. I think it's really important to become a part of the borrower's organization, so to speak, so that you really can help the borrower understand their cash needs or what they can do with their excess cash at times. Jay?
Yeah, and actually just to follow up on that point, in the same article, it talks about respondents listed several service-related items among the things that they wanted from a bank, including an ability to adjust to meet their needs, offering networking opportunities, and serving as a financial mentor. Right? So, by being able to provide that additional insight, expertise, and just helping the borrowers better understand their own finances can oftentimes dramatically contribute to that relationship. But there's always the flip side of the coin, which in the next slide we're looking at the areas of caution. Where in any relationship, if you feel like you get to know a person sort of too well, then maybe you're not double checking or back checking as you should. So in developing relationships, we always want to be mindful that we don't skimp on the analysis during the underwriting process or annual review process, and that we, no matter what, continue to be diligent in tracking and monitoring necessary documentation and financial information to ensure that the relationship remains strong from a fundamental standpoint as well as from a customer-based standpoint. I still remember, this was a couple years ago, talking to a credit officer who was looking at a standardized credit analysis platform, and he was most interested in using it to be able to present to the board why they shouldn't be making certain loans that the board was just rubber stamping. And so it's a double-edged sword as terms of why that is so important, to make sure that you do maintain a regimented underwriting process. I mentioned less comprehensive annual reviews, and finally difficulty justifying the relationships to the board, as I mentioned, but also to the examiners. When the examiners are coming in and they're pulling files, right, they're not going to accept the fact that you've known this borrower for 10 or 20 years or what have you. They want to see the current documentation and consistent analysis to be able to justify that it is a relationship on solid footing.